Hi guys, welcome back to another episode. So today we're going to be talking about BPR. So what is BPR? BPR stands for Balanced Price Range. Now why is this important to know? These ranges are where price usually reacts off and then creates a strong movement to either direction. So firstly, to know what a BPR is, we have to know what a fair value gap is. What is a fair value gap? As you can see here, there are 3 candles. But this candle in the middle creates a gap between these 2 candles and these wicks. This gap in the middle here is called a fair value gap. It is the candle in the middle between 2 candles and this gap of price in the middle. Why is this important to know? Because price usually reacts back into these fair value gaps before continuing to go higher. So now that we know what a fair value gap is, what is a BPR? A BPR is when there are 2 overlapping fair value gaps. In this scenario right here, we can see that price creates a strong downwards movement, creates a level of inducement. However, while going down, it creates a bearish fair value gap here. I'm going to mark this fair value gap out and mark it the color red. On the upside, when it goes back up, it creates a bullish fair value gap here. I'm going to mark this blue. What happens here? You can see that price has reacted back into these overlapping fair value gaps. These overlapping fair value gaps are called a BPR. Once there are overlapping fair value gaps, you want to take the smaller fair value gap in the situation, which is this one, this bearish fair value gap here. As you can see, price inverses this fair value gap before tapping back into it, creating a stronger movement to the upside. So that means, what can we use this for? So we can use this to form a trade. As you can see in this scenario, we can form a long. Place your stop here, place your limit there, place your stop down here at the swing low, and place your target at this London high right here. We can see that we have a 2.09 RR trade from this BPR. So this is only one scenario where this happens. This is a bearish bullish scenario. However, this can also happen on the other side, where it is a bullish bearish scenario. As you can see up here, there are 2 overlapping fair value gaps. I'm going to mark out the bullish fair value gap in blue. I'm going to mark out the bearish fair value gap in red. These 2 fair value gaps are overlapping each other. What this means is this is currently a BPR. So what do we want price to do? We want price to return to the smaller fair value gap. This is the smaller fair value gap in this scenario. As you can see here, price returns back up into this fair value gap before taking out this low here. So we can form a trade off this. As price takes out this low down here, we are going for shorts. So we put our limit here at this smaller fair value gap, or this bearish fair value gap that formed. We put our stop up here at the swing high, and then we put our target down here at the previous lows. As you can see, price sweeps this previous low before continuing to go back up after reacting off this BPR. So to conclude, a BPR is 2 fair value gaps that overlap each other. Price has a strong tendency to return back into this area of interest before continuing to move down. Usually with a BPR, what we want to see is that price has currently already swept a level of interest. As you can see in this scenario, price swept this level of interest here. This zone of liquidity, price sweeps it, creates inducement before making these 2 fair value gaps overlapping each other to create a BPR. As you can see here, price completely takes out this high, creates this new high before making a BPR. Thank you.